Hey everyone, welcome back to Corporate Decoder. Today, D.M.A.A. just filed an 8K about a shareholder meeting, and I am seeing a common SPAC play that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is basically buying itself more time to find a merger target, and some shareholders are heading for the exits. So Drugs Made in America Acquisition Corp, or D.M.A.A. as it trades, recently held an important meeting for its shareholders. The main point of this meeting was to get approval to extend the deadline for the company to complete its business combination, which is basically finding another company to merge with. This report is dated the 27th of April 2026. This is the date when the earliest event that is important enough to report happened. Think of it as the official start date for the news in this filing. Now, D.M.A.A. is classified as an emerging growth company. This means it has certain regulatory perks, like being able to delay adopting new accounting rules for a bit longer. They have chosen to use this extended transition period, which is pretty common for companies in this stage. The big thing discussed was the extension proposal. D.M.A.A. needed shareholder approval to change its founding documents, its charter, to push back the date by which it has to find a company to merge with. This is often called the combination period or termination date. They got approval to extend this deadline originally. They had until the 29th of April 2026, but now they can extend it up to 12 times 1 month at a time for a full year until the 29th of April 2027. This gives them more runway to find the right merger. But here is the catch, and it is a big one. To get these monthly extensions, the company's sponsor, which is like the founding group, has to put more money into the company's trust account. They have to put in either $300,000 or 4 cents for every share that hasn't been cashed out by public shareholders. This is a common way for SPACs to show commitment and fund these extensions. There was also an adjournment proposal. This is basically a backup plan. If there weren't enough votes to approve the extension, they could have postponed the meeting to try and get more votes. Good news for the company, shareholders did approve the extension proposal, so they got the breathing room they asked for. Let's look at the voting. As of the 7th of April 2026, there were over 33.5 million shares that could be voted. Almost 24 million shares were voted. That is about 70% of all available shares. This means they had enough participation, a quorum, to make the vote official, and the extension proposal passed. They got over 18.9 million votes in favour, which is a strong majority. The opposition was about 4.9 million votes. This shows a significant number of shareholders were not in favour of extending the deadline. Because the extension proposal passed with enough votes, they didn't even need to bring up the adjournment proposal to a vote. This is where things get really interesting. Because the extension was approved, many shareholders decided to cash out their shares. Almost 9.5 million shares were redeemed. For a SPAC, a redemption means shareholders are giving back their shares in exchange for their piece of the money held in the company's trust account, which was originally raised during the IPO. This redemption is a big deal. Over $99 million was taken out of the trust account to pay these shareholders. That is a massive outflow of cash. Each share redeemed got about $10.52. This is a classic SPAC scenario. When the deadline is extended, some investors who may have lost faith or need their money back decide to leave. Historically, about half of microcap SPACs that go through multiple extensions end up delisting. So this redemption is a warning sign for D.M.A.A. After all these redemptions, D.M.A.A. now has about 24.3 million shares outstanding, with around 13.6 million of those being from the original public offering. The number of shares not redeemed has gone down significantly, and as a result of the shareholder vote, the board has officially approved the first month extension, pushing the deadline to May 29, 2026. The actual document detailing the changes to the company's articles of association from that meeting is filed here as Exhibit 3.1. It lays out the full legal terms of the extension. And like most filings, there is an interactive data file for the cover page, which helps with financial data analysis tools. The report is signed on May 1, 2026, indicating the company is officially reporting these events that happened at the end of April. The filing is signed by Roger Bendelak, the Chief Executive Officer. Looking at this filing, D.M.A.A. is following a very typical SPAC playbook. They've secured an extension which is necessary to avoid liquidation, but it came at the cost of a significant number of shareholders cashing out. This high rate of redemption effectively means a lot of money being pulled from the trust account, making the search for a viable merger target even more critical. The sponsor has to keep funding these extensions, which can become a drain if a deal isn't found soon. We saw a similar pattern with companies like Tupperware, where extensions and capital injections became a recurring theme before more significant financial trouble. The risk here is that continued extensions and redemptions deplete the trust and make future deals harder to finance. What I am actually looking for is whether they can find a merger target quickly, or if this company will face a similar fate to many other SPACs that struggled to execute their business combination. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take, stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.